Welcome to the daily update, where I'll go over the action in the market for Thursday, October 31st, and we'll see how things look for Friday, November 1st. One of the bigger down days than what we've seen in a while. Of course, we're not really sure before this started happening, were we going to break to the upside? There were still some positive things. The 20-period moving average was holding, but there was weakness developing inside of the S&P, and we ended up breaking to the downside to this point. So we're below the 20-period moving average. We're at the 50-period moving averages. So the intermediate term trend is still positive, still hanging on. We have the employment situation report coming out on Friday, and maybe that'll help give the market some conviction to either continue to go to the downside and show some more weakness or be able to bounce up off of this. We do have positive seasonality being the first day of November, of course. Then next week, we have the election, we have the Fed meeting. There's a lot of things that the market is dealing with right now. And we'll have to just see how these things play out. But it at least showed some conviction in Thursday's session by seeing a lot of selling. And it was a lot more than what we've seen lately. Before I get started, please feel free to check out the SPX Investing Program. It's free until the end of 2024. If you want to learn more about that, you can send me an email and ask me about it, or there's a link that will take you to the website. There's a link to a video that talks more about the program. You get these videos right as they're available, where I delay them on YouTube and Rumble. Also, the daily video is where we've been watching things really closely. I know my videos are longer. I know I show a lot of charts. That's all by design. And so we can see these incremental little changes and subtleties as they work their way through the market. Now, as I said, we didn't know for sure, were we going to break up or break down? But the weakness that we were seeing, of course, you can look back in hindsight now and say, well, yeah, of course, we broke to the downside. And the perma bears are probably calling this a crash in Thursday's session, even though it wasn't down that much on a percentage basis. They're patting themselves on the back for sure. But we're still hanging in there. And watching the daily videos is where you get these subtle little changes from day to day to day. Now, I do kind of a shorter version of a video that's on the website where I just go through the primary indicators. And if watching the longer daily video, you're like, man, I just don't have time to do this, feel free to go over and check out what I post on the website. All right, so let's go back and talk about what happened. And the futures were already negative before we had all the economic reports coming out. Europe was down, the futures were down, and we just kind of fed into things when the economic reports came out that turned things even a little more negative. And we'll go through that here in a moment. We did have on a comparative basis anyway, a huge gap lower. We opened up below S1 at 5,800. So wow, we're below that now. We went down below S2 right at the open, 57.86. And we actually got down to S3. We usually don't see that very often. But S3, I had to pull out the pivot point calculator, and it came in at 57.46. Then we tried to stabilize. We dropped a little bit below that. So we were below S3 as well. We tried to chop sideways at 57.21, but then we closed at the intraday low right down to S4. Haven't seen that one in a long time. And S4 was at 57.06, which is right about where the 50-period moving averages are at. So intermediate term, the support is still holding. We were down 1.86%, a lot bigger move than what we've seen recently, and we were well above average with volume. So yeah, a lot of people got involved on Thursday. And we're negative now in the short term. We're hanging on to support in the intermediate term. We're still positive in the long term. And some of the economic reports that came out tended to spook the markets. And that interest rates were flying around all over the place. By the time we got done, they were virtually unchanged. Well, stocks didn't see that. They just kept going lower and lower and lower. And we'll have to see how things change for the potential rate cut next week. Now, things really haven't changed all that much, and I'll go through that over the weekend where I look at the probabilities. They're still expecting a 25 basis point cut at the next meeting on the 7th. We'll see. Is that going to change with the employment situation report if that comes in stronger than expected? Geopolitical concerns, of course, we're getting closer and closer to the US election now, and a lot of focus is pretty much all on that and any craziness that may happen. But there's still things going on between Russia, Ukraine. There's still things going on in the Middle East, and we just want to keep an eye on those things. All right, some comments. The VIX is now up over 23. So we were getting high readings anyway. Even on up days, we would still be just a little bit under 20 or so. Now, with the down day, we shot up to 23. Mega caps and semis. Earnings came out not well received across the board, and that really saw a lot of selling in the mega caps and semiconductors. That's what led things lower. We're keeping an eye on the Middle East. Oil bumped up just a little bit to 69. The parabolic SAR has now turned negative. We were kind of keeping an eye on that. We were chopping sideways and not really falling, not really climbing, but maintaining more of a positive stance. With the decline, the parabolic SAR is now negative with the dots on top, and I'll show you that chart. We may have gone down too far too fast, according to the VIX, which means we get a very high reading. There's a 9-period indicator that I put on that, and we're looking extreme positive. It's the RSI that I use on there. And now our short-term indicators are looking extreme negative. They just flew right on the list after Thursday's decline. The Stoke RSI, which was already on there. Now we have the Williams percent R, the CCI 14 and 20, the short-term stochastics, and the force index. That was a big move compared to, on a relative basis, to what we've been seeing. We're still looking extreme positive with the 10-day new highs and new lows for the S&P. Yeah, it's dropped, and I'll show you the chart. I haven't been showing that chart. I've just been mentioning it here. And we're already oversold with the S&P McClellan oscillator. Now, last week, we dipped and went extreme negative. We bounced up a little bit. Now we're back to looking extreme. And we're looking a little extreme with one of our PMO studies. And again, I'll show you that chart as well. No change to the scenario for right now. What we're kind of leaning on is this economic strength threatening rate cuts. And that could really come into play in Friday's session if the employment situation report is stronger than expected. The dollar was down just a little bit and interest rates were up, but just barely. We closed at 4.28% with the 10-year yield, where we had been at 4.27%. And as I said, interest rates had really gone up, but by the time things settled, we were little changed. We're still inverted with the 10 to the 3-month, where we're uninverted with the 10 to the 2-year. That hasn't changed. Sentiment, we just blew through the neutral, where we had been at 58, looking positive, and now we are down into the negative area at 44, and we have now turned negative with our trend. The red line has crossed above the green line, and we're still in a weakening trend because it's below its moving average. And of course, with the down day, the bias is usually up day or down day, typically. That was negative, and I'm changing our momentum over to negative. Now, we could get that back if we bounce up off of the 50-day moving average, but until proven otherwise, we are looking more negative currently. The economic reports that came out, one of the bigger days for getting reports, so I'm going to have to take a couple of minutes to go through this. Jobless claims came in weaker than expected, and this is part of what spooked the market or kept the futures negative after this report came out. They came in at 216,000. They expected 229,000. Continuing claims came in at 1.862 million, also a decline from the previous reading. The third quarter employment cost index was up 0.8%. They expected it to be up 1%. So a little bit weaker than expected, but still showing growth. And I'll show you the chart when we go through that. Wages and salaries were up 0.8%, and benefits were up 0.8% as well. Personal income, this is one of the other big reports that came out, was up 0.3% month over month, less than the 0.4% they had expected, but up from the 0.2% that we saw last time. Personal spending was up 0.5%, a little bit more than the 0.4% that they expected and what we saw last time. And the PCE price index was up 0.2%. They expected it to be up 0.2%, so that came in as expected there. Year over year, that is a 2.1% increase. Last time we had the year over year reading, it was at 2.3%. So that was a little more friendly. The big one here, the core PCE price index. This is the inflation component, which takes out energy and food, the things that you have to have. It was hotter than expected, up 0.3%. They expected it to be up 0.2%. Year over year, that's 2.7%. And the Chicago PMI came in at 41.6, weaker than the 47.5 they thought was going to happen, and down from the 46.6 that we saw last time. Okay, here are some charts. Personal income and spending here, both on the same chart, where we have spending pretty much flat, right? A little bit above that 5% level when you look at this year over year. And income is actually declining just a little bit. So not a big change when you look at the year over year reading. The core inflation year over year actually is ticking down a little bit, but it's still above that 2% level that the Fed is trying to get down to. Month over month spending saw an increase. And then employment costs year over year, the total line is blue. That continues to go down. Wages are going down and benefits are going down when we look at it year over year. And Chicago PMI dropped off. We had been getting some stronger readings here through the summer months and into the fall. Well, it's not as strong currently. Weekly jobless claims really came down enough to turn the 4-week moving average down. We had been going up thinking, okay, maybe the employment situation is starting to see some weakness. Not according to this. There was a big drop here, and so we're seeing the overall trend going down. We're also seeing a drop off here with the continuing claims, but not enough yet to turn the moving average down. So taking together, and now the unemployment rate will be updated in Friday's session when we get the employment situation report. And we saw a real drop off in the initial claims, and we're still seeing a decline in the continuing claims. And that suggests the employment situation is holding up. We'll see if it follows through into Friday's session. And is that going to spook the markets? Okay, Isabel Net here. Eclipsing forecasts. The S&P 500 has surpassed Wall Street strategists' year-end projections. We're above that. Well, maybe not so much now, but they thought we were going to be probably around the 5,600 level. We're at just a little bit over 5,700 right now, where we had been at 5,800 before Thursday's session. And then quarterly earnings per share on a year-over-year basis, Deutsche Bank here is thinking that they are going to be down. That's what they're forecasting it out, even though they were coming up and flattening out here. This is kind of what we're paying attention to because we're seeing the economic reports coming out stronger than expected. And this chart tries to gauge that. We're above the 0 point where economic reports are strong. And this is before Thursday's session and naturally before Friday. So if this continues to go up, that could spook the markets into thinking maybe the Fed won't be able to cut rates. And if it stays strong, they may have to actually come in and raise rates at some point. That's the scenario that the market's going to fixate around here. And then I'll also show this in the weekly video, the smooth US probabilities. This is only updated once a month. It really dropped off here. So we're back further below the black line, not really showing a problem of a recession. And we're seeing that kind of confirmed by the stronger than expected economic reports. And then U.S. stocks are on a bullish streak. Well, it's kind of a little bit in doubt right now. It's has declined in only 1 month since July or since November. Unfortunately, with the down day, October ended up being a negative month. So this chart is already a little bit out of date. While close elections see a pullback going in and a rally after, predictable elections have been non-events with equities trending up. I don't know about this year. I mean, there's really clear-cut differences between the Democrat and Republican this time. And usually they kind of get all muddled together. And depending on where you come out, the polarization that we've been seeing in U.S. society now for the last number of years is just getting more and more so, where it tends to be more positive when we have predictable elections, where we see a little bit of weakness here going into a close election. And then once we get beyond the election, that's when we see things turning more positive, according to this chart. I spent some time on Twitter, but nothing really of interest that I found there. So here is the intraday chart, massive gap lower compared. All right. We've seen bigger drops than this, but the pivot points were so close to each other because in Wednesday's session, we barely moved. And so it didn't take very much to get down below S1, S2. We quickly came down to S3 and then even fell below that. We tried to find some stabilizing action here around the 57.25 level, a little bit above, below, a little bit above, came down below again, tried to come back up, and then boom, we saw massive selling going right into the close that took us all the way down to S4. Intraday, that's seeing a little bit of a bounce in the initial overnight session here. But when we look at this, we were really seeing some weakness with the futures, but they were starting to repair themselves and actually look a little bit better. Nope. Then we went boom into the cash session where everything really went down. Yeah, we did see growth. It got hammered in Thursday's session, but the blue line is still above the red line, even though they both declined. And here's the growth to value ratio. Really took it a hit with the S&P growth. I've been trying to focus on this upward move here, saying, oh, S&P growth's kind of hanging in there. Well, as of right now, no, it's not. It's actually seeing quite some weakness. So end of day, growth was down 2.95%. Value was also down, but only down 0.58%. It was down less with the mid caps and about even with the small caps when you look at growth versus value. So not a real big change here. Still negative with small cap growth to value. Mid cap growth to value is still negative. Coming down, we're holding up. It depends on how you look at this chart. Yeah, we're coming down here, but we haven't really broken down and we're still in a longer term uptrend with the growth to value ratio here. So we could recover from this, but if we see more weakness, of course, that's going to turn things even more negative. And we had been seeing some improvement here between the growth and value ETF coming up out of the rainbow. Boom. Now we're back down into the middle of the rainbow. And discretionary to staples, yeah, it declined, but we're seeing more of a decline from staples and less of a decline with discretionary. That's how come this ratio is holding up a little bit better here. And we were down 2.88% with large cap growth, but we're still above the 50-period moving average with this chart. So, yeah, pull back. Yeah, it was negative. Yeah, may have even caught some folks by surprise, but we haven't actually turned full-blown negative, at least yet. The trend here, we have turned negative. The red line is now crossed above the green line. That means we default to a negative trend. The ADX continues to weaken as it's below its moving average, but we're still trending since we're above 20. Short term, red line above the green line, still declining, but still in a trending environment. And we now are really starting to pick up with volume. We've seen the last, well, at least here it's showing the last 3 days above average with volume. Sentiment, we did get the latest reading from Investors Intelligence. Of course, this is about a week old now. They came in at 2.69%. So pretty much neutral. We just pay attention if it gets above 3 or below 1. And VIX really shot up. We're into the 23 range now, and that is more dangerous for the annualized return for the S&P 500 if we stay up there. And when the VIX goes up, the VIX of the VIX also goes up. And we may have gone up with the VIX a little too fast. This is an RSI based on 9 periods. We're just barely above 70 here. It could still go higher, but we're seeing kind of an extreme reading there. And the momentum for the VIX is now gone, excuse me, has now gone positive. The MACD has crossed over and the VIX is clearly going up now. Looking at the seasonality chart of the VIX, not really matching up all that much. We could be getting a bit of a spike here now. We're up into the 23 range. So this chart hasn't been updated for a few days. So we would see this going up, maybe matching closer to what we're seeing here. Even with the down day, the skew index is still in this red area. Sorry about that, folks. I get to talking and my throat just, okay. Anyway, we're up in this area. So is the big move over? According to this chart, no. But we don't know if that's going to be an upward move or a downward move. Now, the skew index is calculated by using out of the money options, where the VIX uses at the money options. And that's why we say a big move is expected, but we're not really sure if it's up or down. To this point, yeah, the evidence would suggest we still have more to go down. And we went up with this fear gauge. We also went up with this other fear gauge. So we're seeing confirmation there. We did get the latest reading from the American Association of Individual Investors. Not much of a change. They're still not extreme positive or negative, but the 50-period moving average continues to go up. And even though we declined with the volatility risk premium, we're still getting quite a high reading here. So this may suggest there's still more to come. And this would suggest that downward movement is still in the future, but we don't know how the market will react on Friday. Didn't see much of a change here with the equity put call ratio. A lot of the hedging took place ahead of Thursday's session. We're going up with the 5-day chart, and actually we started to tick back down here with the 10-day chart. All right, the advanced decline line, yeah, rolling over, showing some weakness here. Maybe a little bit more based on volume, but still above advancing moving averages. And we actually set some new highs here, but we saw a little bit of an expansion of the new lows, just drifting here with our 5-day, where we're continuing to decline with the 10-day moving average. We turned negative here with accumulation distribution. We've dropped below the moving average. The boom indicator is also looking rather negative. And we're still negative in the short term with our advanced decline ratio. That's the blue line. We're coming down and just a little bit negative here with the 39-day, more intermediate term advanced decline ratio. We have now turned negative with the Chaikin money flow. The red line's going down and we've gone from green to red. And the Chaikin oscillator continues to decline below zero. So all three of our smart money indicators are now negative. We've crossed over negative with the vortex. The red line has crossed above the green line. But when you look at this, the cumulative advanced decline line based on price for the S&P didn't really fall apart. I mean, it was down. And then when you see it based on volume, it was actually a little bit more intense. That could end up being somewhat negative. When we were seeing volume leading price to the upside, that tended to be more positive. We're wondering if volume leading price to the downside will be more negative. But this, the 10-day average of the highs and lows for the S&P, it's coming down, but we're still above this green line, and we've been up here for quite a long time. This is more intermediate to somewhat long-term, still suggesting that that's holding together for the time being. Now, we saw a little bit more weakness here with the cumulative advanced decline line for the NYSE. It fell below the moving average, coming down to the moving average with the regular advanced decline line. Also, right about down to the moving average with the other NYSE advanced decline line. And coming down with the common stock based on price here and seeing a little, not too much. We're not really seeing much of an outperformance here between price and volume, but they both showed weakness. Coming down with the NYSE advanced decline line as the S&P is coming down as well. And dropping a little bit below the moving average with the NYSE common stock. The S&P is still barely above the moving average. Mid caps coming down, it's still above the moving average. Small caps have dropped below the moving average. And coming down here and looking negative since we're below 50 with those stocks in the S&P above their 20-period moving average. Crossing below 50 with those stocks above their 50-period moving average. So that's a little bit of danger for the intermediate term. But we're declining, but still positive with the 100 and 200-period moving average study here. And it's hard to see because we got all these blasted pivot points in here, but I don't want to take those off because these are pretty important. Peaking out right underneath this big P here for the pivot point, we're coming right down to the 50-day moving average with the S&P. We saw a real spike up above average with volume. We're declining with the 20, 50, and 200-period moving average study. We're extreme negative with the Stochh RSI, the Williams percent R, the CCI 14, and the CCI 20. We're extreme in the short term with the stochastics here, declining below the midpoint in the intermediate term, still declining but above the midpoint with the longer term stochastic. And we came all the way down and hit this Keltner band. That's kind of like a Bollinger Band. And so we're looking a little extreme here with the force index. And the condition of the 20-period moving average is deteriorating. We're below the green line and the blue line. You can clearly see that. The longer we stay below this, the more these lines will roll over and start to go down. We fell below the 20-period simple and exponential moving average. We've been holding up here for pretty much September and pretty much all of October. Now we broke below that right on the last day of the month. Ooh, spooky Halloween. And we're below the midpoint and we're in the -2 standard deviations channel. So we could still go further down before we get extreme with this chart. And we're negative and declining with the balance of power. The go, no go is changing to the lighter shade of blue. That's negative. We're below the midpoint with the highest high value, and we're starting to see the midpoint rolling over. TTM squeeze, which is just kind of blazing its way lower all along the way, continues to be negative. And we dropped below zero with the ease of movement, where we had been hanging on to a positive reading. The Erin didn't really realize that Thursday happened, so it's still looking positive. We're getting extreme negative with the McClellan oscillator for the S&P. So we're going down with the summation index based on price and volume. And we're declining but not extreme with the McClellan oscillator for the NYSE, but we're declining with the summation index based on price and volume here. And we were a little encouraged by this with the Swenlin trending oscillator. It was ticking up, even though it was negative. Well, it ticked down and it's still even more negative now based on price and volume. Momentum is negative with the PMO going down. We're going down based on price and volume here. Getting a little extreme with the PMOs that are rising. Still declining with the buy signals, declining with the PMOs that are above zero. And we're negative with the Elder's Impulse system for the S&P. Here's a big change. The dot is now on top with the parabolic SAR. That is intermediate term negative, and I consider this to be a primary indicator. We're negative in the short term with the slope oscillator. We're negative with the MACD. We're now negative across the board with our momentum in the short, intermediate, and long term. And we had been negative already. So this is just kind of showing a little bit more enthusiasm to the downside as the KST is breaking a little bit lower. We're negative with the Copic curve. That's another momentum oscillator. And we've been staying positive with the Sean trend meter. Now we're breaking down into this more neutral area. But the context is this is declining. We dropped below 50 with the money flow, and we're dropping below 50 with the RSI 14 and the RSI 9. We're dropping a little bit below the moving average with on balance volume. We're below 50 and declining with the ultimate oscillator. And we're below both the red line and the blue line with our 50-period moving average. The longer we stay below that, the more the 50-period moving average or the 50-period trend, the intermediate term trend, may see some weakness. And we're right at the simple and exponential moving averages here based on 50 periods. So we just sliced through the 20s. Now we're dealing with the 50s. If we see more weakness, we'll be looking at the 100s. And we continue to decline after a sell signal was generated with the bullish percent index for the S&P. But we're still positive, but we're clearly going down. We'll turn negative if we drop below 50. And we're declining with the NYSE bullish percent index, also declining, but still above 50 with the NASDAQ 100 bullish percent index. And after hanging around in kind of these 20-period simple moving averages of the open, high, low, close, we're down below this little mini rainbow now. And we're turning more negative based on the trend here with the Heiken Ashi looking negative. The Renko actually woke up and said, I better turn negative here with a red block. And we're pointing down and red with the Kigge chart. That's negative, and we're turning more negative with the 3-line break. Long term, we're no longer extreme. We saw enough of a decline with the 150 and 200-day moving averages, so we're below this red line here. And we're negative in the short term with the S&P, mid caps, small caps, and Qs, where we're still positive in the intermediate and long term with the Keller market model. So stocks are negative in the short term. We're negative based on price with bonds in the short and intermediate term. Commodities are still negative in the short and long term, and the dollar is still positive in the short and intermediate term. And we only had two defensive areas, energy and utilities, actually be up. All of the other sectors ended up being down, with tech really leading the way lower. And an awful lot of red, not a lot of blue or green here. So it was more like Valentine's Day than Christmas, where the S&P, of course, it opened below 5,800. And then we had the NASDAQ just below 18.6, 18.5, 18.4, 18.3, 18.2, 18.1, blast off. The industrials, which is more economically driven, had a cross below 70 with a bullish percent index. Communication actually went above 80 there earlier in the day. That's growth, and that could be positive. The Dow ended up dropping below 42,000 throughout the day. And since they updated this, I thought, oh, I better share this. We're negative with the decision point scorecard in the short term based on the trend. We've already been negative for a little while in the short term based on the PMO, but we're still positive in the intermediate and long term. And so we're seeing pretty much a matched decline here with the S&P and equal weighted version of the S&P. We came down below the 50-day moving average just a little over a week ago. The Dow set an all-time high, had a hard time getting above these pivot points, had really been going down. Earnings season has not been good for the Dow, and so we ended up dropping below the 50-day moving average. We're coming down to this pivot point here. Will that end up providing support? And we're still negative with the diamonds when looking at the Elder's Impulse system. The NASDAQ, again, kind of hard to see here with all these pivot points on here. But we dropped below the pivot, but we're still above the 50-day moving average. Also, really hard to see, just peeking out a little bit behind this pivot point here, but still above its 50-day moving average with the NASDAQ 100. But we've gone from neutral to negative with the QQQs, with the Elder's Impulse system. The momentum for the NASDAQ 100 is more negative than it had been. And we fell below the 20-period moving average with the QQQs. We're still above the 50-period moving average. Small caps, of course, they had to go down too, and actually dropped down below their 50-day moving average and slightly below this pivot point. And we've gone from positive to negative here with the Elder's Impulse system for the small caps. And then we look at another small cap index, the Russell 2000. We're further below 50 with the RSI, fell below slightly the 50-period moving average, and the momentum is negative for the small caps. And we look at the mid caps, still above its 50-day moving average, but going from neutral to negative with the mid caps with the Elder's Impulse system, still slightly above the 50-day moving average with the Wilshire 5000, but it got hit too. Coming down still a little bit above the 50-day moving average with the total US stock ETF. And just kind of bouncing all around here. Not really, it was up in Thursday's session, but we're in an overall uptrend with the staples to tech ratio, which means staples are in an uptrend compared to tech. But when this goes down, that means tech is outperforming staples. And we saw a pullback here in the financial sector, which has been one of the better areas. The FANG index was down over 3%, but still above its 50-day moving average. And we're coming back down to this longer-term trend line. Now, we broke down below that before, so we may see that, but we're wondering if it will end up providing support this time. We just were not able to get back above this shorter-term trend line. Apple was down 1.82% and just a little bit above its 50-day moving average. In fact, it might be a little bit below. It's kind of hard to see there. Amazon was down over 3%, just a little bit above its 50-day moving average. And Microsoft down a whopping 6% and dropped below both its 50 and 200-day moving averages. Meta was down over 4%, still above its 50-day moving average. Google was down just a mere 1.92%. And Nvidia was down almost 4.75%, still above its 50-day moving average. Tesla was down almost 3%, but still above its 50-day moving average. And Netflix was actually up. It's just been chopping sideways more or less, but it was up 0.3%. And seeing a little bit of an improvement here with US to world stocks on a short-term basis, still seeing a deterioration of the correlation longer term. Oil was up 0.95%. We closed into the 69 range now. And this shows a decline, but we were actually up just a little bit with the dollar. We're still above the 200-day moving average, even though we're in a longer-term downtrend. And so we were virtually unchanged with the 10-year yield, and also virtually unchanged, but down just a little bit here based on price, even though that says down, even though this kind of down on a closing basis here. And then we're seeing a little bit of weakness with our growth to value ratios. Earlier in the week, we were encouraged by what we were seeing. Now we're seeing a little bit of disappointment here when we look at the Qs to S&P coming down to the moving average. Now, this is a little encouraging, discretionary to the S&P, going up above its moving average, but coming back down to the moving average when we compare large cap growth to large cap value. And coming down to the moving average with the large caps, still a little bit above the moving average with the mid caps, and coming down to the moving average with the small cap growth to value ratio here. And just kind of chopping around right now. But overall, we've been declining with the S&P to utilities ratio, and that is more negative. And we came back up here, but overall, we have been declining when we look at the staples to S&P ratio. That could be more positive if this continues to decline. So what's our outlook for Friday? We're turning negative. Now we're already negative in the short term, but we're still hanging on to looking positive in the intermediate and long term. We're below the 20 period moving averages, but still above the 50 period moving averages, and weakness is really starting to grow right now. And we have had a lot of earnings coming out. We had Apple, Amazon after Thursday. We'll have to see how that impacts Friday's session, in addition to all the other things coming out. So we're going to get the employment situation report, the global U.S. manufacturing final reading, construction spending, and the ISM manufacturing. So we have three big reports: employment situation, the manufacturing PMI, and ISM manufacturing as well. And then all the geopolitical things, including the U.S. election here, finishing out the calendar for the week. And here is just a look at what the previous readings were and what the forecasts are for the reports coming out on Friday. Seasonality, we are positive with the Dow, S&P, and NASDAQ. Now, I went through because we're starting a new month, so I'll go through this for just a second here. Now, way back, seems like ancient history now, but in January, we had an up January, and the year ends up following 72.6% of the time when we have a positive January, and that's what happened. So January was up 1.6%, and then the average is almost 20% for the year. Okay, the best 6 months starts in November. We're just coming out of the worst 6 months. Now we're coming into the best 6 months. So we do have some positive seasonality. Over the last 73 years, in the month of November, we're up 68.5% of the time. We're down 31.5% of the time. And then I'll deal with options expiration as we get closer here. Here's the Carson composite chart showing that once we bump through what's going on right now, at least on a seasonal basis, we could see things really move to the upside. But there's a lot of variables out there, and there could be a lot of upheaval about the election that could eventually feed over into the market. Where the first half of November tends to perform quite well, the second half performs a little bit better. Going back to 1950, Friday is the second most positive day of the week based on 2023, and it's also the second most positive day of the week based on 2024. And we're seeing a real drop off here, the blackout period for companies. So if they see dropping of their stock price, once they get out of the blackout period, if they come in and start buying, that could give some support to stocks. And here's another one from 76 to 2023, just showing the median non-presidential election year ends up doing a little bit better than a presidential election year. This dashed line is when the election actually happens, but we do see some positive seasonality either way you look at this going into the end of the year. It's not automatic, but this is historically what we've seen. And then the S&P, when we're around a close election, we often see a drop off going into the election, but then some strength after that. And the November to April timeframe is up 7.1%, and 77% of the time it ends up being higher. We're coming into, again, no matter how you look at it here, some positive seasonality for November. And we're up 11 out of 18 times, down on 7 out of 18 times with a return of 2% in November going back to 1950. So the warning signs, we do have this confirmed Hindenburg-Ullman, but nothing was updated there. We're keeping an eye on these defensive sectors. We've been watching those for months now. The 5-period equity put call ratio is going up. And we've had accumulation distribution turn negative, as well as the Chaikin money flow and the Chaikin oscillator. Both the 20 and 50 period moving average study for those stocks inside the S&P are negative. Parabolic SAR has turned negative. The Swenlin trading oscillator is negative. And the S&P and NYSE McClellan oscillators, with the S&P already being extreme negative, but the NYSE still has a little ways to go if it continues to fall. And the summation indexes are negative for both. Momentum is negative based on oscillators and the Koppel curve. Vortex, it has now turned negative. Ease of movement, money flow, and ultimate oscillator have all turned negative. And growth to value, which, like I said, a couple days ago, we were encouraged by this. We're still encouraged with the large caps. Can that come back? And we're seeing where discretionary to staples are hanging in there okay for right now. But the momentum for the NASDAQ 100 is negative. Positive signs, kind of a short list right now. The 10-day equity put call ratio is going down. The advanced decline line, and I'm basing this mainly around the S&P 500. We're still above the moving average, but we are seeing some weakness there. And the bullish percent indexes, because they're all above 50, they're still positive, but the context is they are declining. And the financial sector, yeah, I got hit on Thursday with everything else, but it's still looking pretty solid there. So our conclusion, we are turning negative. Now we could easily switch back to turning positive if we get a bounce on Friday. But right now, we have really switched over to the negative side with weakness continuing to grow. In the short term, we're now negative because we're below the 20-period moving averages. We're still positive in the intermediate term because of those 50-period moving averages. We have the confirmed Hindenburg moment with weakness also growing, where we are still positive in the long term. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.